Disclaimer: this is an educational case study in quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, hello everyone, and welcome to The Explainer. I'm your host, and today I'm putting on my hat as a skeptical financial investigator. We are diving deep into the financial statements of a company that is pretty much defining what it means to be high risk and high reward right now. We're going to objectively dissect the AST SpaceMobile paradox completely strictly by the numbers and without any of the hype.
Okay, let's just dive right into this contradiction because it's a wild one. Imagine a company that spends a staggering $610 million to make just $31.5 million in a single quarter. A company that misses Wall Street's earnings per share estimates by over 190%, reporting a 77-cent loss when analysts were expecting a 26-cent loss. Back in the first quarter, they missed revenue expectations by a whopping 60.7%. Yet, somehow, following these massive, glaring misses, the market digests it favorably and shares actually climb. As data-driven analysts, our job isn't to just blindly follow the crowd. It's to look at the raw numbers and figure out exactly why this is happening.
Section 1. The Earnings Paradox. To really grasp this wild market reaction, we need to strip away all those lofty promises of the future and look objectively at the actual data. When we dig into the fundamentals, there is just a staggering contrast in their quarter-over-quarter growth. While top-line revenue more than doubled sequentially, jumping from $14.7 million in Q1 to $31.5 million in Q2, mostly driven by U.S. government contract milestones and the delivery of 13 commercial gateways, you really have to look at the CapEx row. Capital expenditures absolutely exploded from $256.8 million to over $610 million as their manufacturing accelerated. And naturally, that pushed their earnings per share even further into the red, dropping to a loss of 77 cents.
Furthermore, adjusted operating expenses surged from $91.2 million to $119.1 million. Now, as an investigator of financial statements, when I see a sudden jump like this, I want to know exactly why. Well, the footnotes in the filings tell us this is due to heavy workforce growth and facility expansion, specifically expanding their manufacturing footprint down in Texas. The scaling up to address a massive total addressable market, sure, but it highlights a massive accelerating cash burn that really puts their capital efficiency under a microscope.
Section 2. Financials. Burn versus bank.
So, here is the crucial point. We need to figure out how a company can sustain this level of cash consumption without completely collapsing under its own weight. I mean, a $610 million quarterly CapEx burn rate? That will annihilate most balance sheets in a matter of months. The answer lies in their bank. Specifically, they're sitting on a massive pro forma cash and cash equivalents war chest of over $3.7 billion. Now, you might be wondering, how does a pre-commercial company get that kind of cash? It actually came from a recent $1.15 billion convertible note offering back in July, which, combined with their existing reserves, gives them a very healthy current ratio of 18.47. This incredible liquidity gives them the actual runway they need to fund this aggressive infrastructure phase without facing immediate insolvency.
But a huge bank account is only half the story. Alongside that cash runway, their future revenue potential is massive, anchored by a $1.3 billion contracted backlog. And this isn't just loose interest or verbal agreements. This backlog is bolstered by 3 recent U.S. government defense contract awards that have a funded near-term value of over $100 million. What that tells us is that institutional and government players are already committing serious capital before the commercial network is even fully live.
And to really add fuel to the fire, they just received a preliminary award for Japan's J-LEO project. This represents a total expected value of up to $1 billion in non-dilutive, non-debt government capital. Essentially, these Japanese-flagged satellites are going to be identical to the rest of the constellation and usable globally, but Japan is footing a massive part of the bill. From a balance sheet perspective, non-dilutive capital is the absolute holy grail for a company currently stuck in a high cash burn phase.
Section 3. Technology and constellation scaling.
Now, a $3.7 billion war chest is fantastic, but it's practically worthless if the technology doesn't actually work or can't be manufactured at scale. AST SpaceMobile is rapidly scaling its manufacturing in Texas, aiming for a target of 6 satellites per month. They've already successfully launched Bluebirds 8 through 13 in a super tight 50-day window, with 14 through 16 basically ready to ship. They are working incredibly aggressively to establish an initial constellation of 45 satellites in orbit by early 2027. Hitting this scale is exactly what will allow them to transition from a pure development company into an actual commercial service provider.
And the thing is, the tech is actually working. Their custom ASIC chip is now at full production, and it's achieving a record-breaking 98.9 megabits per second. Those are speeds that legitimately rivals traditional terrestrial broadband, coming directly from space. And management is stating this chip is expected to nearly double peak data speeds to roughly 200 megabits per second in the near future.
This brings us to a really vital distinction. As CEO Abel Avelin notes, they have the only platform demonstrating true broadband capability today. They aren't just doing basic SOS texting from space. They are deploying the largest ever phased arrays in low Earth orbit. We're talking combined aperture hardware of approximately 20,000 square feet just across their first 13 satellites. That is a staggering amount of physical infrastructure in space, which honestly goes a long way in explaining that massive $610 million capex bill.
Section 4. The Partner Ecosystem Moat. Let's put on our equity research analyst hats here for a second and evaluate their economic moat. Morningstar often defines a moat by factors like network effects and intangible assets, and AST SpaceMobile has built an incredibly wide one. First, look at their intangible assets. They've secured over 3,900 patents and patent-pending claims, and they're hoarding spectrum rights globally, including 1,150 megahertz of low and mid-band spectrum. Second, their network effect is massive. They've partnered with over 60 mobile network operators worldwide, absolute heavyweights like AT&T, Verizon, Vodafone, and Google, which gives them direct access to a combined 3 billion subscribers. The barriers to entry for a competitor to try and replicate this exact ecosystem are just astronomically high. Given this massive accumulation of spectrum and partnerships, their economic moat is set up to rapidly expand over the next 3 years.
Because of this moat, management is actually projecting they'll approach $1 billion in revenue in just their first full year of commercial service. And what's really fascinating here is the revenue mix. They project that government contracts could account for a full 50% of that pie, with the remaining half coming from commercial infrastructure and service revenue. It's a highly diversified revenue base, all built on top of one single satellite constellation.
Section 5. The risks ahead.
But as objective investigators of these financial statements, we absolutely cannot ignore the deep red flags buried in their execution timeline. A great backlog and a big bank account do not automatically equal a profitable business. To survive and ultimately thrive, they have to execute perfectly. Step 1. They have 10 launches booked across 2 separate providers, but they cannot afford any delays, especially since they're actively choosing not to rely on Blue Origin's return to flight this year in their internal models. Step 2. They have to successfully launch their already delayed consumer beta trials. And step 3, they desperately need to drive down their incredibly high satellite unit costs, which are currently sitting between $21 and $23 million per satellite.
And we have to remember, widespread commercial service hasn't even started yet. The beta trials are targeted for later in 2026, meaning all of their near-term revenue is entirely dependent on lumpy, unpredictable government milestones and gateway deliveries. If those government checks get delayed for any reason, that $610 million quarterly capex burn is going to start looking incredibly scary, no matter how much cash they're sitting on right now. So let's bring it all together for our final verdict, juxtaposing the two very different realities of this company. On one side, you have a massive total addressable market of 3 billion subscribers, a $1.3 billion backlog, $3.7 billion in the bank, and validated 98.9 megabit per second technology, forming a very wide economic moat. But on the other side, you have the sheer gravity of their operational reality. A $610 million quarterly capital expenditure, a 77-cent loss per share, and immense execution risks tied to rocket launch cadences and totally unproven commercial rollouts. The financial paradox of AST SpaceMobile presents a completely unique high-risk, high-reward scenario. The fundamental models clearly point to incredibly high potential if they can scale this thing, but that aggressive cash burn suggests a very turbulent storm ahead if they miss a single step in their launch schedule. I've laid out the data for you directly from their filings, so do your own homework, dig into the numbers yourself, and let me know. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Thanks for joining me on The Explainer, and I'll catch you next time.